All right, initial reaction here is blips lower, dollar index is higher. CPI, dollar index higher, S&P flat, Nas flat, euro dollar down, pound dollar down, gold mixed. There goes the euro and the pound. Dollar index is up. Let's have a look at the numbers. Looks like it might have been a 2.6, 2.7 headline. That's my guess. 2.6, 2.7. Okay, actually 2.5. So 2.5 core CPI, however, was higher than expected. So we did get the 2.5% reading. S&P 500 a little bit lower on that. US 30, so Dow Jones also lower. You get the NASDAQ a little bit lower. Dollar index is up on this data point. Arguably that would be, hold on, let me get the year over year. FX Street. Let's pull up FX Street economic calendar. Okay, so core, I'm looking for the core year over year. Consumer price index, X food and energy core year over year, 3.2. Okay, so came in as consensus expected. We had the consumer price. So core came in line 3.2% year over year. The consumer price index year over year came in 2.5%. Consensus had it at 2.5 or 2.6. I saw it a couple different ways, different places. So inflation cooler than anticipated on this side, at least. 0.3% month over month for core. So slight uptick from expectations there. Interestingly, NAS and S&P, they're not a huge sell-off today. It's not a huge reaction. You got a 0.4 for the NASDAQ, 0.4 for lower on the S&P 500. Gold here, slightly lower. I'm interested in understanding that a little bit better. So 2.5% came in as the year over year number. That's a big drop from 2.9%. I would actually say that that's, arguably pretty good news for stocks. Perhaps it's that core CPI just upticking a little bit here and not looking as promising. Remember, core CPI is when you take out the food and energy components of it, which are the more volatile components of the consumer price index. So the core CPI here slightly higher. It seems like it was basically an as expected reading, to be honest. The forecast was 2.5. We've got 2.5 here. Dollar index is slightly higher. NAS and S&P 500 are slightly lower, but really not making all that big of a move. Let's switch back over to our main market view. Get a little bit of a closer look at this. So 2.5%, again, not quite enough to get gold to break through the highs. If we take a look at the S&P 500, not enough here to really get a huge price movement going on the S&P. The NASDAQ also modestly lower here. The Dow Jones a little bit lower. Russell down 1%. So some areas getting hit harder than others. And we could take a look at some, just for a brief second here, take a look at some sectors. Let's just see how technology is looking here this morning. So technology is just modestly lower. Utilities, nothing. XLY, so that's discretionary. Healthcare, staples. Interesting. Yeah, kind of a muted response, to be honest, guys. Down 0.4% for S&P 500. NASDAQ down 0.4%. This actually probably is, if you were somebody who bought puts or bought calls, this is definitely not your day, because this is, volatility is probably getting crushed. Let's see. Well, actually, look at that. Volatility spiked in both directions. Interestingly, again, gold slightly lower here on the 30-minute chart. Take a look at the 4-hour chart. Still, yet again, this will be the, how many times has this happened? 1, 2, 3, 4, 5, 6, 7, 8 different times prices come up to this area and rejected off of it. To be fair, each time it's come down to this area of support, buyers have aggressively bought it there. So, gold is really stuck in a range, it seems. It cannot really get out of its own way. Can't seem to break out. And I was hoping that, CPI would give us enough juice to move one way or the other. But gold continues to range. I continue to hold on to it. Mention of health. XLV is an ETF that tracks healthcare. Once you look at the Nikkei, sure, I'm short the Nikkei. It's been all over the place. I'm slightly in profit on this one, but yesterday, it shot lower, didn't quite take out the lows, reversed course here, and now I'm just about at break even. So not too exciting anything there. If we do see a drop off here in indices today, I imagine that the Nikkei will probably also follow suit. But yeah, kind of mixed on that. All right, let's see what we've got. Dollar index, again, saw an initial spike higher. Daily chart still intact here, I would say, for at least a recovery move in the short term. But the thing with the dollar index is, I really think you needed juice here to get the dollar index to break through. I'm talking about like a 2.7, a 2.8 CPI, like a surprise of what analysts were thinking. Didn't quite get that. So for me with the dollar index, I'm just kind of neutral on this one. I think if anything, I sort of do lean bearish if we had seen a bigger retracement up, but can't really do anything with that. I want to take a look at some things here. I mentioned earlier, seasonality in the month of September keeps me a little bit worried on the indices side. It is one of the most bearish. This and October are not great months for the S&P 500. If you're someone like me who trades the indices a lot, this is worth paying attention to. Seasonality, month to month. By the way, if you guys would like to try out the Edge Finder, the software that I'm using here, which helps me look through tons of different macro data, seasonality data, the Commitment of Traders report, and our top setups algorithm each day. If you don't have a copy of the Edge Finder and you'd like one, we've got a 30-day trial available you can apply for. We'll drop the link here in the chat so that you can do that now. Again, it takes like 1 minute to apply. Just tell us a little bit about what you're looking for in the software, and someone from our team will set you up with a trial for 30 days access to the Edge Finder. So we can drop that link here in the chat, and it'd be awesome. Again, S&P 500, NASDAQ, actually close to flat off of that.
With Pulver Alerts, you get access to the complete log of all of Chris Pulver's trades. But who is Chris Pulver? Chris has over 20 years of trading experience, and he's a licensed money manager. He trades all aspects of the market, including Forex, stocks, ETFs and futures, crypto, commodities, and just about everything else. Let's talk more about where you can find these trades. Inside of the A1 Trading Discord, on the left-hand side, you'll find Chris's section. It's broken up into different categories to make it easier to find the trades you're most interested in. Here, you can browse his trading journal, where he shares videos and general market analysis, his indice trades, commodity trades, Forex, stock and options, and his futures trades. All trades come with analysis, including entries and exits, risk to reward, and more. We're very excited for the future of Pulver Alerts, and we hope you are too.
So the Bank of Japan offers very low interest rates. And think about it. If you want to go borrow money, where do you want to borrow money at? You want to borrow money where it's cheapest to borrow money. And the Bank of Japan is kind of like the best option on the block for borrowing money. So for years now, we have seen the Bank of Japan be the piggy bank of the world, meaning everybody goes and borrows Japanese yen or sell yen to buy other assets, real estate, companies, cryptocurrencies, metals, invest in, bonds, all sorts of different things, anything except keeping it in the Japanese yen. Mm-hmm. But now with recent developments, with central banks around the world starting to cut their interest rates and, perhaps fear of a slowdown in the world, the trade has changed a little bit, Ivan. What has changed in the yen?
The Japanese CPI slash wage growth slash growth in the economy, slight growth for the past 30 years. So I think inflation is now 2.9 or 2.8 or so. So yeah, they are getting some inflation, and then they have increased their interest rate from -0.1 to 0.25, which is a quarter. And they are supposed to, by end of the year, maybe hike another time to 50 basis points.
Yeah. And to kind of draw a little picture to go with your idea, I've got this on the screen. So Japan is seeing some modest growth, which Japan's economy has been like not great and been unimpressive. We've discussed this. Ivan and I have gone back and forth on Japan as a deep dive for the last year, talking about how they have an aging population, not a lot of GDP growth. They've kept their interest rates rock bottom in order to try and stimulate their economy, and they've struggled with it for a long time. That being said, a little bit of promising stuff coming into Japan, but maybe what is the bigger, more volatile component in this equation is what if the rest of the world experiences bigger downturn? Then suddenly that very modest Japanese growth looks very attractive relative to losing a bunch of value in other places. So it kind of depends your thought. If you're somebody who's like, yeah, the world looks like it's on the fringe of finally seeing some sort of economic slowdown that's persistent, we're seeing evidence of that. If that becomes a bigger theme, maybe the Japanese currency and maybe investing in Japan or at least just staying cash heavy looks a little bit more attractive, causing the big sell-off that we've seen recently and the Japanese yen. So Ivan, you think there's potential for this to continue to go lower?
Absolutely. I just had to think for 2 seconds because we saw CPI today, and I was a bit surprised by the US side of it because as a very big opponent, it came at 2.5. So that means dollar weakness going forward. And Japan is now turning a bit higher. So I think that with this lower CPI in the US, we have more legs to go. Now, remember, it's always going to be where to get the cheapest money for the best reward, and it has been so far one of the best carry trades has been either New Zealand or the US dollar. Now that the US will start their rate cut seasonal cycle now in September, which is now confirmed today with the lower CPI. This one is going to have not a lot of legs, but yeah, some legs, extra legs. Because remember, we started, was it 2021? We had a bottom, so that's 104. I'm not going to say we're going to go down to 104 on the dollar against the yen, but that's where everything started from. So we'll see.
Sure. Yeah. No, and definitely something to watch is the state of the Japanese economy, but also very closely, I think that the more volatile component is where the world economies are at. We're seeing inflation come down in the United States, continuously, maybe a little bit of a rocky road to get there, but we're seeing inflation cool in many places, and it is expected that you're going to see other central banks starting to cut interest rates. I actually think that the big price action signal here on the yen is if you're watching this and you're like, let's get some proof here in price action. If you get a break through those lows, we have to start really scrolling out, Ivan, to get an idea of where this thing could go. Because look at this. This is January and December of December 2023, January 2024. We have erased all of those massive gains in the dollar yen. All of that has been erased. The yen has taken back with a vengeance where it was at. And the next key level here that I see, I'm looking at this and I'm saying, wow, we could go all the way down to 138.50 pretty quick if you start to see global economic decline sort of persist. What tells me, what scares me about a recession, Ivan? Oil. Have you seen oil? Oh my gosh.
What do you mean? Like, isn't it better to have low pump price or something? Like, isn't that lovely to have $1 at 66? We can go back to where it was pre-COVID.
Yeah, I mean, it is, but my goodness, it does make me a little nervous. We take a look at the weekly chart. We are sitting near the lows, March 2023. We've erased all of the oil gains here this year. And, obviously, Ivan and I we're joking, like, who doesn't love when the gas pump is a little cheaper? The signal, though, that's a little bit concerning is, why is it so cheap? You got to start thinking beyond like, okay, my gas price is low. And yes, Ivan just hinted, he gave the hint away. China's data came out really poor. We've got economies around the world showing signs of slowing. And again, this is part of the reason why I'm just cautious on indices right now. Yes, there's the chance that we do see a soft landing still. And I think that that's probably fair, but there's a rising risk that maybe the landing won't be perfectly soft. We're seeing oil. You have to ask the question, why is oil trading at $67 when the economy, if you're thinking the economy is going to be strong, oil should be holding up because people should be bidding it up. Transportation should be high, shipping and travel and everything should be booming. So you would think oil prices would stay strong. But that to me makes me a little nervous, Ivan. And I think that yes, the inflation figure is down, but is inflation coming down at the peril of the global economy? That's the question.
Good question. Yeah, it does give us a bit of a bad backdrop. So I don't know how to read charts, but I think the same price we've had is back at 8th March 21.
Interesting.
So that's the price over there.
Yeah. Very, very interesting. You're right. March 2021 goes back to even same levels we were at 2018, 2019. Crazy. But yeah, I don't know. It's a tricky one for me because you've also got, it's almost like you said, it's like inflation's cooling off. Shouldn't we be cheering right now? And meanwhile, you've got oil taking out the lows and the stock market's down today. That to me signals that the market is sensing a possible recession. And again, I don't want to come out and say like, oh, I'm thinking there will be a recession. I'm just thinking that there's a rising risk of one, which is something that can move markets by itself.
Oh, the mind twist in that question.
Oh, no.
There is two sides to every coin. There is your truth, there's my truth, and probably somewhere in between there's truth.
Yeah, right.
But another way of looking at this market is there's a bottom. Let's buy.
Actually, so Ivan, I say all of that where I say kind of the pessimistic, like, oh, oil is falling apart, and I'm not trying to be pessimistic. I actually, if I spoke with my actions, I sold a put on ExxonMobil, which is of course a company in the oil and gas space. So I actually think that oil prices are not going to stay at these levels for forever. And I've started to sell puts on companies in the oil and gas space. So I'm kind of buying the dip on the longer term, but in the short term, I think that it does signal some concerning stuff for global markets and for uncertainty out there. So, at the same time though, gold is down 0.5% here today, which is kind of a confusing one to me. I would have actually thought gold might have taken a stab at taking out the all-time highs, but not quite.
What does it need, do you think, to breach 25? 2,500 and something?
I think you needed to see the 50 basis point cut. If you were going to see an explosion up to, 2,600, if you were going to see that move take place, I think you needed the 50 basis point cut in September narrative to become stronger. And I think we missed that opportunity with the jobs data being mixed and CPI being cool. It's not like enough to decisively say, oh, the Fed is going to cut 50 basis points. And that's what I think you needed to get the big move happening on gold. Would you agree, or is there anything I'm missing?
Nah, also what I think is this is just a bit what do you call it in English? Delayed gratitude, not delayed returns. Meaning, I think that we're gonna need FOMC. Because in my world, in my market world, there's a lot of people who does by fact. So some pension funds go by fact. When we actually are going to start rate cutting, actually do change monetary policy change, that's when they will act. Many people have already done.
Yeah, no, I was just going to say, I think you're right. I think that in the event that the action starts taking place, like they actually begin cutting rates, I think that will be a good environment for gold to continue its rally. Now, that's probably why gold is already up 20+% this year, is the market's like, oh, that environment is coming. But I do actually agree with you that once that environment begins, it can continue to give gold a nice boost. And at any point in the rate cut cycle, we have to think ahead on this, Ivan. Like right now, we've been discussing, oh, rate cuts are coming. When are they happening? But let's think ahead to a couple months when they have started to cut rates. Our question will be, are they going to accelerate rate cuts from here, or are they going to go slow from here? And if you get at any point an uptick in fear about where the global economy is at, it is possible that gold in that rate cut environment, if they start speeding up the rate cuts, gold probably takes off with that. So I still like the upside to gold going into 2025. I stay bullish on it. I think that the only scenario in which I really get bearish on gold is if the rate cut story falls apart, the economies of the world like reaccelerate heavily, and there's just not that big backdrop anymore.
Yeah, of course I forgot where that one went. But I was trying to find, I said it the other day because I need to do head math, that we have priced in how many rate cuts by 1 year now. So September, so 22, 3, 4, 5, 6 rate cuts by end of year. Sorry, by in 12 months time. So if they start rate cutting, maybe 2 rate cuts in either November, December, I think it's going to accelerate that they're going to price in even more rate cuts in next year, of course supported by CPI. So I think that once the snowball starts a bit, I think it's going to take a bit off. The only problem, and we're always going to say this, Nick, but by the end of the day, if this rate cut starts to kick in, when is CPI going to pick up again? Because that's the goal, or try to not make that fall too much. But one rate cut now is going to be looked at or seen in like May next year or so.
No, that's actually such a good point, Ivan, because if you think about like, okay, rate cuts start, where does inflation start to pick up? We actually want to see inflation start to bottom out. Like if we're trying to really look ahead to our own commentary a year from now, we're going to be questioning, okay, if inflation keeps coming down, we want to actually see inflation start to bottom, right? Yeah. So we don't want to see inflation crash through 2%, which would indicate recession hardcore. We want to see inflation do a little bit of a landing itself and stay okay. So I do think that, the stock market's reaction here is, I think we're entering into the next phase of this story of the fundamentals, which is, okay, rate cuts are now starting. Where do we want to see the data fall after those cuts begin?
Can you pull up the US CPI? Because that was obviously, I was about to, like, that doesn't look like dollar, but it's been so resilient to fall. Like, what is in Europe now? Europe is 2.2 now or something like that. UK is somewhere in the region of that about as well. But then if you add 2.2. So because if you see compared to euro or pound, dollar has risen a bit, fallen a bit, now falling a bit again, but those are the economies that has responded more or better to the rate hikes or changes in restrictive territory. So my honest fear is that once inflation now starts interest rates start cutting, money gets cheaper, this inflation is going to quickly go back up again. Because it's been so difficult to get it down.
Yeah, it's been so difficult.
And actually,
that difficulty has been the resilience of the U.S. economy. So I do think that also stacks in, with this 25 basis point cut. Why I've never really been in the 50 basis point cut is because look at the U.S. economy's track record. It keeps outperforming expectations. And so the Fed, I think, is going to be a little bit cautious to cut 50 because of exactly what you just said. They don't want to see, okay, if you cut 50 basis points and the economy just booms from there, you're going to have the inflation story come right back. So I think that the process of cutting rates very gradually and slowly could kind of thread the needle of getting inflation to stay low, but also the economy to not fall apart. So we will have to see.
Wild start to the day, huh? I'm looking at a 5-minute chart.
Yeah.
This is nuts, dude. We've literally started 96 all the way down to 21, like 70 points straight red on the 5-minute chart. Pretty impressive for a CPI reaction, huh?
There's a lot to unpack there. Yes, I think it's very interesting because should have been a good number, right? 2.5. That's not bad. 2.5%. We're getting real close to targets here. But I think I've been trying to unpack this in the stream here today.
Yeah.
I think what might be concerning the markets too is that, okay, you've got oil slippery slope falling down. You've got the labor market data, which has not been super impressive. I think there's a potential here, Chris, that we may be seeing this weak CPI print spooking investors a little bit. Why did the forecast slip down to 2.5? Yes, it's good news, but remember that inflation can cool off dramatically if the consumer is cooling off dramatically, if prices are not rising because people aren't spending as much money. I don't know. There's something's not right here, because again, a couple months ago, a CPI print miss or down to 2.5% would have gotten this thing kicking to the upside.
Yeah, it was Frank actually pointed out. I saw that yesterday. He was like, hey, it just printed 2.5 for the forecast. I'm like, that's crazy to do that yesterday.
Yeah.
Did you also notice the CME watch tool? So I was in a session right before this, and yeah, I mean, I'm sitting here like, look, we have some structure. If we have, clearly the market was directional. I ended up putting in a center trade right in here that I ended up bailing and taking the loss. But this is also the difference between today's open. By the way, this was yesterday's open. That was easy pickings for profit. This was Friday's open. That was easy profit. Thursday, easy profit. And then today, not even close to the same. So it's just like the market's like, no, we're going to go crazy on the day. So what I ended up doing, I shared this trade with Frank yesterday. I have a dual butterfly spread, and I posted this in the alert section for A1 Trading. So I did share this trade. In fact, in my section here, let me go into, where to go? Discord. There we go. And I'll go into my section. I believe I put it in as a futures trade. Where's my section here?
Scroll down a little bit.
There we go.
There you go.
Okay. This is the trade that I'm in. This could be my saving grace for a potential payout today. So I basically put on 2 butterfly spreads. I shared the image down here with what the trade looks like. The expiration is today. And so if price is in either one of these profit traps, then there's potentially to pay, 10 to 1, which the total debit was about $6. And this would be about a $30 credit max profit. So, I mean, I can certainly make up for the net debit and have one trade pay, but here's the live look at that trade. Let's go to Thinkorswim. Here's the live look at the trade. So if price continues to push lower, right now the shaded zone you see in gray, this is now the expected move of the S&P or the ES feed. Mm-hmm. So if price does get into that expected move, I mean, anything in this profit trap, this 545 credit, this is now trade. This is a debit in real time, but that's if you took the trade now. I'm going to look and see what it's trading for as an overall credit, because ideally what I want to see is, okay, I know that I paid $6 for both of them. So this is $3 here and $3 here. I'm scribbling like crazy, but $3 here and here. If I see this trading at, let's say, I don't know, I mean, like $15 is pretty good. $20 is pretty good. I might end up managing some profit if it comes into that peak today. So even though I took a small loss on a strangle trade, I might have this as enough volatility to get me something that's good, something that's very profitable, and it's a low risk, high reward strategy. And that's what I'm monitoring. So right now, my overall positions, P&L, pretty manageable. I don't know what your drawdown situation looks like with a down day, Nick, but I'm only upside down like $5,000. No, it's not a big deal.
Because I'm super cash heavy.
Are you? Okay. Well, and that happened like last week, right? Like that first week kind of stopped out a lot of positions. Yeah.
Yep. Which has been the right play. It's been, kind of actually the right play on like where I was heavily exposed, which was SMH. I stopped out on that one, which saved me probably a big slide of like 6% on that position, at least on the allocated money there. But yeah, no, I'm looking at it, I'm thinking, I just think that with the September seasonality, with the election, with the labor data cool, I'm just cautious. I'm not outright bearish. I think that rate cuts will be good for the economy, will help things out, but I'm seeing some warning signals. One of the big warning signals I keep coming back to is that slide in oil makes me a little bit nervous about where we're at globally. That's telling us something, because as you were joining here today, Chris, it was like, okay, oil's down dramatically, but it's not like we had some big peaceful resolution in the Middle East or peaceful resolution in the Ukraine. So the supply side's not changed all that much. It seems to be slowing demand. And also OPEC themselves actually cited slowing demand for oil. So you're getting all these signals that, okay, demand for oil is wavering. You have to ask why. And oil holds the key to the castle so frequently in the markets when it comes to, the global economy. Like oil is almost a good signal of where it's at. You just have to kind of filter out some of the wars and supply issues that muddle that,
Just ignore all that stuff going on.
No, right. No, that's not what you know what I mean. Like the demand for oil, just the demand side of oil is very important. The supply side can be impacted by wars, and obviously we want peace in the Middle East always. Like that's a terrible, sad situation. But from specifically the market's perspective, it's like demand for oil or the lack of demand for oil can give you a good read on kind of global economic health. So just something to keep an eye on. I do still have, like I said to you the other day, this short position on the Nikkei, which has been in and out of profit, not gone too far anywhere. I'd like to see if we can take out those lows. I could start trailing the stop on this one, but just trying to stay mostly cash heavy, see if we can get a bigger rip to the downside, in which case I would look to slowly start picking up and deploying stuff. I sold some puts on some stuff. Here's where I'm currently selling puts. So I sold puts on Nvidia at that 95 price that we've discussed the other day. I sold a put on Google. I sold a put on Exxon. So got some puts floating out there that I've sold, and still long gold, still short EWJ, which is the Japanese stock market, and sitting on a whole lot of cash in the meantime, just kind of waiting to see what happens.
I like it. Yeah, I mean, I see. So this is a currency strength chart, the Japanese yen. I had a chart alarm go off overnight with the Japanese yen future, so we did poke those recent highs. That's a crazy amount of volatility yet again on the yen. Up to the top of the food chain, all the way back down to baseline, all the way back up again as the market opened up. Yeah, it was an interesting reaction to CPI. Like you said, initially I was watching the futures market. This was the CPI print right here. So CPI market reacts down, comes right back to the weekly VWAP, pushes up here, and then just freaking dumps. So there's clearly some manipulation going on. I mean, look at this. This is the ES. I think this is the ES feed, or is this I think this is the NQ over here. This is the NQ. Okay, so this is NASDAQ. If you look at this chart here, Nick, you would say it's pretty simple that we're in a downtrend, at least for right now. Like there's all this level. We're making lower highs and lower lows. And so even today, right into this cluster of support, and price just reacted from it. So, we look at the NASDAQ heading lower. Your puts that you have, those are looking good. I bought the MNQ at 18,000. So if we start to see, IV swell a little bit of risk off trading, Frank might get his volatility play that he's after. I know he's long the VIX, so that's got to be elevated a little bit today. It's back up into the 20s, so we're up 11% of the VIX today.
Did he tell you about his SPX 5500 yesterday?
4 points, right? He was just by his chinny chin, right? 4 points.
I was watching him right at the close. He was watching it to see if he was gonna get max profit or not. But yeah, it should be interesting.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.